Good evening and welcome everyone. My name is Jerry Bone. I'm a farmer and cattle feeder from Pratt, Kansas. I also serve as the president of the National Cattlemen's Beef Association this year. I'm pleased to welcome you to our webinar series focused on risk management tactics tonight. As participants, your line will be muted, but feel free to type in questions in the question box on your screen during the webinar, and at the end of the presentation, we will get to as many of those as time will allow. If you have trouble with your technology, or if you're joining us only for the audio, the webinar is being recorded and will be available for viewing in a few days at ncba.org. Just look for the producer tab on the website. The webinar tonight, titled Hedging as a Risk Management Strategy, will feature Tony Drake, the Vice President of Agricultural Trading at Phillips Capital and the owner of DT Group LLC, a group that specializes in working on ag consultancy projects. I've known Tony for a number of years, and I promise you you're going to enjoy his presentation, and he really knows what he's talking about. Tony has worked in various areas of the livestock industry for over 40 years. He began his career with Cargill Incorporated, working for a subsidiary in Chicago called Cargill Investor Services. At the time of his departure from CIS in the mid-2005, Tony was running all U.S. agricultural futures execution. Tony formed Drake Trading Group in September 2005, which combined a futures execution on the trading floor of the Chicago Mercantile Exchange. The 10-person group eventually became one of the largest volume broker groups in the livestock quadrant. Around early 2016, he began consulting and was eventually hired onto the CME as Senior Director of Agricultural Products. In 2019, he joined Phillips Capital to work on building their agricultural business side. Tony, it's a pleasure to have you with us tonight, and the floor is yours.
Jerry, thank you very much for the introduction, and thank you for allowing me the opportunity to discuss risk management in the live cattle space. My name is Tony Drake, as Jerry said, and I've spent over 35 years working with clients in the livestock arena to help them understand risk management. I'm excited to do that again today for NCBA. So let's kind of set the tone here on what we're going to do here today. Let's set the agenda. What we want to talk about is what is risk management and exactly why are we talking about it? You know, I think it's important that we set that tone early. We're also going to talk about tactical steps you can do to reduce your controllable risks. And this is involving a strategic plan. It's going to be very individualized. You'll have to devise yourself. They'll be very individualized to your business, but it'll help you kind of understand your costs and what you need to do to get there. We're going to take a look at evaluating options and futures. And we'll have some case studies at the end here that we can go through. And at the end, I want to talk about sources to help you understand the details. You know, we're going to have a lot of people on this webinar who have all kinds of different exposure. Some hardly at all to futures and some to futures. And so I want to be able to put some details out there for everyone that they can use and learn what we're trying to do. So the first thing, let's just start off with what is risk management, you know, and the textbook example is basically risk management is a structured approach to managing uncertainty. I like to refer to it as transferring risk to another party. And that's what we're talking about when we get into the futures and options discussions. But it's really about putting a plan together as well. You know, we want to talk about reducing these negative effects, these downward price shocks that we've seen over the last 2 or 3 years. And to get there, we need to look at what is risk management, and we need to discuss that. So why is it important? You know, at a high level, and just like this says on the slide, mitigating risk is crucial to a sustainable operation. As a cattle feeder, a rancher, whatever you may be doing here, there are financial risks in the system. And so there's a comment from a good friend who's been a cattle feeder for years that I'd like to share with you all. We got talking about this webinar that I was going to put on, and I asked him his thoughts, and he said something that really stuck with me. You know, he said, if you're not hedging, you're playing defense. If you're hedging and you're putting together a risk management plan, you're playing offense. And I'll add to that, it's tough being an ongoing concern if you're always playing defense. And so that's what this webinar is really going to be all about. We need to sit and look at where you're vulnerable today. You know, is it buying feeder cattle? Is it selling the fats, you know, in the feed yard? Is it buying grain? You know, what can it be? And to mitigate risk when possible, so we got to focus on those controllable inputs in the business. We don't want to focus on things like weather. We don't want to focus things on random events. We can't control those things. We've got to focus on what we can control. In a few slides, I'll talk about those random events. So our goal here, when you get done with this, is for every individual to sit down and to really run through the big picture strategic plan for yourselves. Everyone's going to be a little different, you know, and that's what's important through this thought process. How do you build the strategic plan? So this is very similar to a lot of you. This may be foreign to some of you. So, you know, you sit down and you look at your cost of production, and you got to think about what your rate of return is going to be. You know, think about your break-even levels, setting those target prices. You sit down and evaluate pricing alternatives. Do you use something like an LRP? Do you use something like futures and options? Do you use contract cattle with a packer? You know, you go through and evaluate all these different pricing alternatives. And then you constantly have to review this plan. As 2020 has proven to us, you never know what's going to hit you. And so that's where you got to constantly review this plan. I have a point at the end of this slide here. Timing the market is very difficult. And what this really means is when you put this strategic plan and this hedging program in place, it's not something you just do every now and then. It's a program. You got to keep doing this program. You know, it's because you just never know when something's going to hit us. And the last 2 or 3 years, it seems like those 100-year rains, we've had like 4 of them. You know, so it's just important that we look at this plan, that it's an ongoing program that you do. I took a look, wanted to throw some of these random events, those uncontrollable events together. And I started writing these things down on this page of this webinar. And it got really scary when I got to the end of it. You know, things like, you know, export bans and recalls and competing meats. We all know those are events that we can't control, but we've been very familiar with them. Who ever imagined we'd have something like COVID-19? I mean, that just blows my mind. And on top of that, how about a ransomware attack this year? You know, something that, you know, you just don't expect. We can't solve these events. These are events out of our control. Everybody out there probably knows that. I mean, I'm driving this point, maybe even drowning this point, that stuff happens and we have to be prepared for that. And so when I started writing these drivers down, I'm like, well, okay, we can write these off because they really are things we cannot control. So what we need to do is look at the things that we can control. And so the next few slides here, a big shout out to CattleFax for supplying about 5 of these slides in here. I'll do a plug for those guys. If you don't work with CattleFax now and you're not a member, please do. They have fantastic information. So on this first slide here, I just kind of wanted to show the seasonality of cattle prices. And I went back and I had the guys in CattleFax put together a chart for me here that gives me the 5-year average with a couple of the last 3 years. And you look at that green dotted line, that's your 5-year average. And it says here, we typically get a $20+ break in prices from our spring high to our fall low, our summer low. I mean, that's enough in itself. But then let's just look at the red line, which is 2020. That's a roller coaster if I've ever seen one. We start the year off around 124 and we end up at 95. Now, I'm not telling anybody out there that doesn't know that already. But look at the swings in that market during the year. And that's just, and I'll be driving this point several times tonight, that just shows you how volatile our markets can be. We can't ignore this anymore. I mean, as an industry, we've got to recognize this. And this is what, again, the goal of this webinar is to get everybody thinking about how to put that plan together. My next slide here is really a longer term look to it. It's quite amazing when you think about the moves we've had in the last 10 years. Go back to 2014 when I was on the trading floors, and I remember that move to 174. And within 2 years, we're at $1. And then don't even think about that. Look beyond that. Go across this into the 17s in 2018 and 2019. You can see these swings are just part of the market. And so our goal here, and I am drowning the point, is just showing how volatile this can be over time. And we just can't sit back anymore. So this next slide is really important because it does talk about basis. And basis is critical when we start thinking about hedging and the impacts of that. CattleFax did a great job showing this chart, and it's actually the next slide I've got here is also along the basis, but I like this approach here. The gray bars you see in there are the 10-year averages, and they've set it up with the contract month at the futures exchange here with the CME. And you can look at, let's just pick on May, and May shows about a $9 10-year average basis compared to, cash prices compared to the June contract. But what I want to point out in this, and this is critical when we look at basis, is when we get market shocks like we've seen, and I'm going to pick on last year because that's the classic year right now. That's the blue line that you see there. When we get market shocks to the downside, it's the job of the futures market to figure out where that clearing price is going to be. Where does it need to go to clear beef? And of course, when we were going through 2020, we had, packers slowing up kills. We were losing kill capacity. If it could go wrong, it went wrong. But look what that blue line did. It went to over $15 basis in May versus the June contract. If you're a short hedger and you were short hedged going into this mess of a year, you were able to mitigate not only some of that damage of the downside, but the basis helped you even further in this impact. And so that's the one point I want to bring up. If you're a hedger, you're playing offense. And that's the key to what we've got to think about as we move forward. So this next slide is, again, another look at basis, but it just shows you in 2020, just how far positive we went on basis. The gray dotted line you see right there is the 5-year average basis. The blue line is back to January of 19 versus the nearest futures contract. So it's very typical in May to show those spikes in in positive basis, because we're comparing to the June contract. And the June contract is trying to figure out where your summer lows are. So it's ahead of the game. So it's very, very typical. Well, except for 2020. Look what happened there. We went as high as $20 positive basis during that time period. And I heard a lot of people telling me how the live cattle contract at the Chicago Mercantile Exchange was broken. And what that contract was trying to figure out was, where does it need to go to get that price that moves cattle and gets cattle killed? And it did. Did it go too far? Most likely. That's what futures markets do. They go too far, whether it's up or down. But that's the key here, is that those short hedgers were able to take a little bit more off of the table on their futures hedges because of that extreme basis move. That doesn't happen every year. But in those shocks to the downside, we get that type of positive basis. And I want you to kind of move a little bit further out, though, into the March of 2021, this year. Notice how negative our basis got. When we got to the beginning of this year, everyone started thinking, okay, when's the bull market going to start? The market the futures market started to price in that next big move. And this time they're looking for the positive side. And you can see how negative our basis got there. Futures got ahead of the game, as they do. And again, gave us a little bit of a negative basis. And then as you see, we get into the May here where it's comparing to the June futures contract, and our our positive basis is nowhere near normal, or nowhere near average here. So again, the futures market is trying to project the next bull move. And if you look at our curve on the futures exchange right now, you can see it's nothing but higher prices all the way out into April of next year. This page is really here to paint the picture of how much of the industry really hedges. So in a nutshell, this is the implied percent of U.S. cattle on feed that are hedged. And this is the Commitments of Traders report under the Commercial Short Open Interest tab compared to our cattle on feed. And you look at the 5-year average, if we're 50% hedged, that's a big number. And you can see we're normally around 45 or into somewhere in those 40% area on our hedging. That's a lot of cattle that are letting somebody else determine the price when they market those cattle. And that's why we're doing what we're doing today. So this green bar, I want to point out last year, 2020, and you can see we started the year off at 50%. And as the market broke and we were selling cattle, we became less and less hedged. And as you know, looking out on the curve in March, there wasn't a lot of hedging opportunities, on the futures market, because we were just, trying to find that low price. And that 35% is a legitimate number, but then again, you've got to take it somewhat with a grain of salt, in that it was very difficult to put anything on a hedge past March. So hence we remained a very low percentage. So I know we've got a lot of different people and different exposures to the markets on this webinar. And so what I want to go through is I want to make sure we all understand the definition of hedging before I step forward from here. And so in a nutshell, taking an opposite position in futures from your present cash position. And that's the definition that I'd like to use for hedging. So I compare it to compare it in the cash and the futures tabs on this slide. In the cash market, you're the owner of the inventory. You could be feeding cattle, and you have cattle in a feed yard, and they're 2 to 3 months out from being bought by a packer. So your risk, obviously, is in down markets. You move over to the future side. To offset that risk, you need to be a seller of futures. In other words, a short. So when your risk is in down markets on the cash side, you gain in down markets on the future side. Likewise, on the other side, if you're a user of inventory, your risk is up. Say you want to buy feeder cattle 3 to 4 months out, you're worried about cash prices going higher, you need to be a buyer of futures. So as your risk is to the upside, you gain with a long futures contract in that market. So I just wanted to get that, make sure we're all on the same boat and the same level on that. So I put together a case study for y'all. I'm going to do one on futures, and I'm going to do one on options. And so there's some assumptions in here that I want to throw out. These are all real prices that I picked from this year. So I figured, well, I want to feed cattle, make a 4.5 month type feeding cycle here, and I want to do something that ends before this webinar. So I picked January 15th as my start date that I was going to place cattle on feed. And I looked out there on January 15th, the futures, June futures, were at 115. The cash price on January 15th was 110. And we move forward, fast forward out here to June now, to May 28th, and I said, okay, what's my June futures price now? So it was 116. I just looked back on the data here, and the cash on May 28th was 120. So I chose this specifically because I just wanted to do one for this year. We could have gone back many years and picked different scenarios, but I just wanted to make it, for this year only. So on January 15th, we're going to put 40,000 pounds of cattle on feed. That's one contract, one futures contract. So to hedge that, as we learned, we need to sell one June future at 115. At the same time, we're thinking about our basis, and our expected basis we're thinking is $1.50 positive over June futures. So on the cash side of this, we're expecting a net price of 116.50 for June delivery. That's purely the futures market plus the expected basis. That's all that is, 116.50. We have no idea what's going to happen when we get to June. We just are thinking that's what the market's telling us on January 15th. Fast forward ahead, like I said, to May 28th, we're going to sell those cattle. So we need to buy back that June future, and on this date, June futures closed at 116. So we bought them back at 116. Our basis, as you can tell by our cash and futures prices, is now $4 positive over June futures. That helps our hedge. Basis worked in our benefit here. And so we also sell the cattle at 120. So on the bottom of this, I want to go through the different summaries of how we did on the hedge. You know, the pricing summary, we talked about that, 115 on the futures. Our basis we think is going to be a positive $1.50. So we're thinking we're going to be selling cash cattle at 116.50. Don't know, but that's what we think. The future summary. So we sold the futures at 115 and we bought them back at 116. So we lost $1. You know, that's in our hedge there. So we go over to the hedging summary. That cash selling price of 120, better than we thought, which is great. And thank you for the basis. We lost $1 in the futures. So we subtract that $1 and we got a net price of 119. And that's just a real world example. And the goal here is we want to be able to sleep at night. You know, so we had no idea the cash was going to 120, but we knew we had helped locked in a price here from our early hedge. So I want to talk a little bit about what does it cost to trade a futures contract. For those who have never done this before, I factored in a very expensive commission rate just to kind of give you an idea of what it costs. I said we'd have a $50 commission rate. That's probably way too high for what people are paying nowadays. And we have CME fees and NFA regulatory fees. So that amounted to about $54. And if you take your net revenue of 119, roughly $47,600, and you subtract the 5410, you get your net out of that, $47,545. So I wanted to throw that in just so people understood, if you've never traded a futures contract before, just what that cost is. So now I'm going to shift gears a little bit, and I'm going to move over to the options side. And again, I know we've got a diverse group on here, so I want to go a little slow here to make sure we all understand the terms that we're going through. So I've got a couple pages of terms here to bore you with. One, what's an option? So an option is basically a contract between two parties that conveys a right, but not an obligation, to buy or sell a specific commodity at a specific price. Well, that's a lot of words in here. And so let's compare them, you know, versus options versus futures. So futures are an obligation. It allows you to lock in a price. Just like we did on that case study, we locked in a price and we went forward. Options, on the other hand, allow you rights to buy or sell at a certain price. So you may not want to exercise that right to have a futures position. With an option, you can do that. And with an option, and we're only going to talk about buying puts in this deal. We're not talking about selling options, but in buying puts to hedge, you pay all the costs up front. No margin calls. With futures, you can potentially have a margin call if the market goes higher. So a little more terminology I want to run through with y'all. We'll start with calls, but we're going to spend most of our time talking about puts. And that's what we're going to be trading when we're going to do our case study on puts. But calls convey the right, but not the obligation to buy a futures. So the buyer of a call has the right to buy futures at an option strike price, whatever strike price that they buy. Thus, on the other side here, the seller of that call will have the obligation to sell futures at that option strike price if the call is exercised. So that's the important part here. Now let's kick over to the put side here. Puts convey the right, but not the obligation to sell futures. So a buyer of a put, and that's what we're going to be as a cattle hedger, the buyer of a put has the right to sell futures at that option strike price. Likewise, a seller of a put has an obligation to buy futures at that option strike price if the buyer says, give it to me. So in other words, exercises that put. So we're going to talk a little bit about in the money and out of the money as we get to our case study here. So I'll get on that on the next slide, but after this one. But options are a little bit like insurance. And we're talking about buying puts. We're not talking about selling any options here. So if you pay the premium to buy a put to get protection, that's the cost of creating a position if you decide to exercise that into a futures position. So let's just look at this. If the cash price moves favorably, in other words, up, and futures move up as well, that option does not exercise, and the buyer of the option loses the premium. So in all cases here, if you buy a put and the market goes straight up from there, you've just paid the insurance for the coverage you didn't need. It's kind of like buying car insurance if you never have to use it. On the other side, if you buy this put and the cash price moves adversely, in other words, futures and cash go down, you can exercise this option into a futures position at that strike price, and then you're covered. So I'm going to throw a case study, the exact same case study that I just did in futures in an options trade this year. Again, just picking a trade date and picking that what happened on that day, all the same assumptions in here, but this time we're going to buy a put. So on January 15th, we're going to put 40,000 pounds of cattle on feed, obviously one contract on the live cattle contract, but this time we're going to buy a put. And so I bought a June 114 put. And if I were to exercise that 114 put, that's where I would be short in futures at 114. This put is slightly out of the money versus the futures price of 115 on this day. So I paid a kind of a steep price to buy this. I paid $3.85, and that's going to come factored in here later on. Again, basis, we're expecting the basis to be the same, $1.50 over. But this time, our expected floor price with this put is 110.15. I'll show you how I came up with that. Go down to the pricing summary here, and you have your options price at 114. Yeah, I subtract out the $3.85 for the put, and so I have a floor price of 110.15. If the market goes dramatically lower from here, my futures price will be at 114, where I'll be short. But I want to factor in the cost of this put that I paid up, and that's where I'm coming with my floor price. Same things all over. Fast forward to May 28th. We sell the cattle in the cash market. So the cash market is 120. So we sold the 40,000 pounds of cattle at 120. Look down to our summaries here. So we've done our pricing summary already. Look at our option summary. The buy option was $3.85 to buy that option. To sell it on May 28th, there was 30 cents left in the price of the option. So what the options cost us was $3.55. So the reason for that is that we only had about 5 to 6 more days of trading in those options when we took them off. So the time decay was constantly taking money out of this option price. And as you can tell, it's a 114 put, and the futures are at 116, so it's still out of the money. And so that starts to lose a lot of money in those last 5 to 10 to 2 weeks or so of trading. But let's look at our hedging summary. So we sold the cattle at 120, just like we did in the futures study. This time, I want to factor in what it cost us on the put. It cost us $3.55. So our net price on this trade is 116.45. So you're saying, wait a second, you know, the futures price did a better job on our net price than the options. Well, in this case, basis didn't play as strong an input as it did on the futures side as it did on the option. But then also on the option, we were still out of the money and losing time decay and all that going into the last few days. But remember, I never had a margin call. So when I bought this put, I paid this money up front, and that was it. And that's the price to be able to sleep at night, as I say. So that's the differences between those two. And again, it depends on, doesn't mean you have to do one or the other. I could use a different year and come up with different scenarios, but that's just how it worked out this year. So again, I want to show that cost of trading that put. Same thing, $50 commission fee, which I factored in a very high fee, with CME fees and regulatory fees, $54.10. So we just took that net revenue number of 116.45, which was 46,580 bucks. That's 1.1645 times 40,000 pounds, and we came up with that number with the net number being 46,525. So again, just trying to show you the cost and how small it is for the commissions and fees versus what you're really dealing with on each contract. So what we look at here is, you know, why futures and options? You know, what are we trying to get done here? So the first thing we want to do is we're hoping to lock in a price, you know, or maybe we want to cap input costs. Maybe we want to hedge our grains that we're buying for our cattle. We want to look at protecting the inventory. This is what the game's about. I mean, this is what we're talking about today. We can't go through these negative shocks to the system. You know, we want to reduce the risk of seasonal price moves. You know, I went back to that chart that I showed you earlier here in the webinar. You know, we've got at least a $20 break potentially from our spring high to summer low. That's a lot of risk to take. You know, we want to minimize damage from long-term cyclical moves. We want to minimize damage from shocks. You know, we want to look at controlling risks, you know, in other parts potentially of our business, like I said, on the grain side, and potentially capturing a windfall pricing opportunity. Those are all real important things for us. You know, so that's why we're doing this today. So again, I have thrown a lot at y'all, and I know there are people on this webinar who have a lot of experience in futures, and there are people that are not, that don't. And so where do you go from here? You know, what's the next step? So the first thing I would do is I think you talk to a neighbor, a friend, someone who is hedging. And if they've got a broker they really like, reach out to that broker, you know, get some more questions answered from that broker. They're usually great resources. Secondly, ag extension agents out there, a lot of county ag extension agencies that are out there, and these agents are a wealth of information. They're good people to reach out to start educating yourself along those lines. Next, where else do you go? The ag schools that are in this country have phenomenal resources available for producers. They have great data on hedging. They have great data on basis levels. They're just great sources of information and learning. And so I do recommend that. I've worked with a couple of them.
The CME offers some fantastic information, and I'm a little biased because I worked there for 2.5 years and built and updated a lot of the futures education that's out there. And the Institute page at the CME is absolutely great. Has a lot of written and video educational stuff on seasonal and basis and hedging with futures and hedging with options. And so I really, truly recommend trying those out because I think there's just a great amount of information there. And again, all 4 sources are free. There's nothing you have to pay for. And I don't think you even should have to pay for. And so that's a good place to get started. Everyone's going to have a different approach in an individualized plan. So that's what we want. And lastly, thank you. Thank you for your time. Appreciate you all taking the time to sit in and listen. And my contact info is on this slide. Don't hesitate. Reach out if you've got more questions, things you want to ask. I'm here. And hopefully I'll be in Nashville here in August. Hopefully if you all are going, I'll get to see you there as well. And Kayla, I'll turn that over to you.
Thank you, Tony. NCBA is all about bringing the latest relevant information to our members and the industry. And Tony certainly helped us achieve that goal tonight. Now let's get to your questions. Thank you again for participating in the webinar tonight. And I'll hand it over to Michaela Klauser, NCBA staffer, to moderate the question and answer part of our webinar. Thank you.
Thanks so much, everyone, and thanks for being on with us, Jerry. And thank you, Tony, for an excellent presentation. That was some great content that you shared with us tonight. And with that, we can just go ahead and roll right into the Q&A portion. So we've kind of had a theme with some of our questions tonight from the smaller cow-calf producers. So Tony, I just didn't know if you could expand on what the benefit would be for those smaller cow-calf producers, what they would get from hedging, say around 50, say around a herd of 50 head.
So again, you know, when you look at the contract itself, it's geared for about 50 head on the feeder cattle. contract, not the live cattle contract. But if you're hedging, if you've got calves that you're going to eventually sell into the marketplace, your risk is if that calf market, that feeder cattle market goes lower. So you can use the feeder cattle contract, which is a cash settled contract. It's a little different than the live cattle contract, to hedge. And I believe it's 54 head, if I remember correctly, on the how many head on that 50,000 pound contract. In this case, as a cow calf, if I'm reading this correctly, your risk is the price of those feeder cattle going lower down the road. And again, that means you need to be a short hedger on that. And very similar approach that we talked about on these case studies is instead of protecting an animal like a fat cattle, like I did here already, you're protecting a feeder. I hope that answered the question.
Yep, that definitely answers. So I was just wondering if you can go ahead and expand on the difference between the live and feeder cattle contracts.
Sure can. So our live cattle contract dates back to the 70s, and the feeder cattle dates back just about that old. And the live cattle contract is just that, live delivery contract. Doesn't mean you have to take it to delivery, but it means that it's settled, and when it goes into the delivery period, it can be settled with the live animal. The feeder cattle contract is cash settled, and it's based on a 13-state average of prices that the USDA reports to the CME, and they compile that into an index, into the feeder cattle index. Both markets represent what's going on in the cash market itself. Now, you have a basis differential in both markets. Feeder cattle basis can be technically wider at times than the fat cattle. I think the cash settlement option can sometimes allow feeder cattle to go a little further, both sides, up or down. Their threat of delivery is not there. But as you get into the last month of trading in feeder cattle, it narrows up very, very much so. But again, those two contracts are meant for different animals. On a live cattle contract, we're talking about an animal that's going to be, 12 to 13 to 1,400 pounds, whereas you're talking about a feeder cattle of 700 pounds. So again, the feeder cattle market, contract is geared towards those feeder cattle.
Gotcha. Yep, that definitely does. So can you explain basis further and how to analyze it so you can use it to your advantage?
So basis is going to be specific to your area. That's critical here. Whether it's feeder cattle or whether it's fat cattle. It's very specific to your part of the country. Whereas right now, we take a look at this week's cash prices in fat cattle, and I'll just pick on that. Our northern market is a little bit higher than our southern market by about $2, give or take. So your basis in Nebraska is going to be different than your basis in Texas. So that's why I always recommend, and when I talked about getting started, where to go with help, this is where the universities and your ag extension agents can all provide a lot of help. This is where CattleFacts is awesome, is that they can provide that basis data that's in your part of the country. And that's part of that plan. That's why I talk about just how individual these plans are. That's really part of this plan. Everyone's going to have a little bit of a different plan. So when we look at basis, and again, cash minus futures, that's what we've got to plan on. There is a seasonality to the basis. It's like I showed you on this one of these last charts. We showed how the futures market, present futures market, is carrying big premiums in here. It's trying to figure out the next bull move. So in other words, that's actually helpful for a short hedger in this environment. And so, but again, when we look at basis, it's very individualistic. It's very much in your part of the country. Now, Kansas could be the same as Texas for a while, and then they may diverge, or Iowa could be similar to Colorado. but they'll diverge. And so you look at that individual database of those numbers, and that'll help you project out, like I did in those case studies, what you think your expected basis would be. Critical to get the data. And again, I'd recommend CattleFacts. They have fantastic stuff.
Yep, that is some really helpful information. We have a couple more questions coming in. Tony, can you please explain margin call?
I sure can. So when you trade a futures contract at the CME, you do not have to put up the full amount of money for the value of that contract. You're able to put up a portion of that money as good faith deposit, as I would call it, for that contract. And if the market moves for or against you, let's say in this case you put on a cattle hedge, you've shorted the market, and let's say the market goes higher. So your cash cattle are gaining value, but your futures contract is now losing value. So to maintain that good faith deposit, they make you put up what we call margin. And so in other words, you're not putting up a full amount of the cost of that contract. You're just putting up a portion of it. So as that market goes against you on the future side, you have to put in extra money. It's a margin call. You have to put in extra money of good faith deposit to that futures contract. And so by that, and so you're saying, okay, well, where does that money come from? So mostly, if you've got a working line of credit with a bank, you're typically pulling that from that credit line with the bank and paying that margin call. So the theory behind this is just that. Okay, I'm having to put more money into this futures contract, but my cash business is becoming more valuable. And so that's why we say hedge. That's where the offset is. But that's a margin call. And so, and I'll give you some of the good, the bad, and the ugly about that. You know, you go back to 2014, when we went to 174. We had a lot of ugly margin calls in there. People were having to put in a lot of money because the market was going very much higher than anyone expected. You had locked in most likely a profit, but you had to keep putting money in to that futures contract. At the same time, you were selling cash cattle in the 170, and you had to cover your futures trade. So that's the thing about futures. Some people don't want to make margin calls, and that's fine. You don't have to. You can trade options where you go and buy a put and just buy your floor price and go on. And you know what your cost is, and it's all fine. But I would say one thing you want to talk with is a banker. They're a great source of when you talk about margin calls. They can help you through that process. And again, one of those sources I recommended, getting a competent broker, a good broker that someone your friend likes, your neighbor likes, whatever, and they can work through that process with you as well. But what that is, and again, I'm going to give you the opposite side of this. Say the market goes down, you'll get some of that money back. So it doesn't not just one-sided, it goes both ways. So, you know, but again, remember, if the market's going down and you're getting money back from the futures trade, you're losing money on your cash side. And again, those two should, to an extent, level off and even each other out. But again, I recommend, you know, and again, if you're new to this, these are great questions. This is when you want to start talking with a broker or even with the university sources or a county ag extension guy or girl. These are the great sources to go to get even more answers on that. And a quick plug for some of the stuff I put on the website at the CME. It's also run through on there as well.
That's super helpful, Tony. Yep, it's always good to find those local sources when folks begin to explore into this portion of cattle marketing. So we have a couple other questions coming in. Can you couple hedging with other voluntary marketing tools such as source verified programs like such as that?
So when you get into premium programs, there's a little bit of a difference in here. You know, you're going to probably sell source verified, like a premium, you know, if you've got a lot of prime in your, you know, whatever that may be, you know, naturals, whatever it is, those markets will carry a higher price than your commodity cattle price that you're going to see out there. And so the prices that I just quoted here, 120 to 122, or whatever it was in Nebraska this week and in Texas, you know, those are more the average prices. So what that means is you still need protection. You still have to have protection. COVID-19 last year proved that again and again. But your basis is going to vary a little bit more on this now. So instead of having maybe it's a $2 basis during this time period, a $2 positive basis, it could be potentially bigger than that. Or it could be less than that. It just really depends. And this is where you do your work to know your data. And you got to go back and look at what you're selling every week or every other week or however often you're selling cattle on like Source Verified, and look at what your premium is to the rest of the market. And likewise to the other side, if you're selling something that's maybe, you know, less than that, you know, look at that discount. And so that's important when you figure that basis out. It's just critical. And a lot of the data you're going to see is just, you know, the average price out there on basis. So your goal, and just to make it a little tougher for you, you've got to figure out what you're selling at a premium or a discount to that number, and then you figure your basis from that. I hope that answers the question.
Yep, that definitely does, Tony. So there have been some concerns raised regarding the role of CME speculators and their impact on cattle prices. In your view, can you mitigate risk under this situation?
Yes, to answer that question real quickly. So what does the speculator do at the CME? The speculator is the liquidity provider most times for what you want to do. If you want to sell, you need a buyer. You know, if they're a buyer and you're a seller, that's a great connection. You know, we have a lot of managed money in the futures open interest. We have a lot of indexing money that's in the futures business, but we have a lot of speculators as well. And now that we're totally electronic, we have a market maker that is also in our marketplace. And those market makers provide liquidity for the hedger or anybody else for that matter that want to trade in that marketplace. I think it's critical that we have those speculators. They're very important for the marketplace. And again, for me, this is about a liquidity provider. Markets are volatile. I agree. They're more volatile now than they've ever been. I'm not sure you can explain it away with just one thing. Does a speculator make our futures market more volatile than 10, 15 years ago? Well, yeah, you could potentially say that. But then you could also say that we're a more world market now than we've ever been, and we're getting affected by more random events than we've ever been affected by, which contributes to volatility as well. But in a nutshell, I think it's important for the speculator to be there. I think they add liquidity to the marketplace, and I think they're important when you need to get something done on the futures exchange.
Great, Tony. We are having quite a few more questions coming in. Let's see here. Should managing risk be reactionary or be done prior to a purchase decision?
Wow, that's a great question. I have talked to people who have pre-hedged, in other words, before the actual transaction. I have talked to a lot of people that only do it when they hedge. I would say as what's the most logical, it's probably the minute you buy your feeder cattle, boom, you want to hedge the market, you know, because you're buying those feeder cattle based on the idea of what the futures are getting. I have known people to pre-hedge as well. And I get it. If you're going to go through with the purchase of the feeder cattle, let's say you're putting them in a feed yard and you've got your short on, I get it. But you know, these examples I used were, you know, identical on the same day at the same time. You know, I would tell you that it probably makes sense, especially if you're just beginning this process, to do it at the time that you place those feeder cattle. That way, if something were to terribly happen and the market rallied in price after you sold it on a Monday, but you didn't put the cattle on feed for another week, it would, basically hurt you on your basis. So I think it can be done both ways. To answer the question, I would say if you're just starting off in this program, I would stick to doing it at the time you put the animals in, blocking animals.
Yes, thank you, Tony. We have time for one more question. Have you examined any of the new government risk management solutions, and do you feel that they are viable tools for producers to utilize?
I have looked at, and I assume they were talking about like LRP, the Livestock Risk Program that USDA has. And I have taken a look at that. It's a bit limited in its scope because it's funded by a government grant. And so when it's kind of like an insurance program, kind of writes a little bit like an option, to be honest with you. And it's quite interesting. Again, it's limited. And so what they're doing in this program, just to give you an idea, it's basically a put that you're buying. And then they subsidize that put, so it's cheaper than what you would probably buy on the Chicago Mercantile Exchange. And that's the nice part about the program. And they turn around and they have a risk taker on their side that they're offsetting that risk on, and so that they have a bank, I think, taking on the other side of it, so that the USDA doesn't hold the risk in the put. All they're doing is subsidizing the price. And it's limited just because of the grants that are put into it. And I do know they've talked about increasing the scope of the program. I don't know anything more than that. I don't think they have quite yet, and I'm sure that's something that'll come up in this session in Congress. But it is something to definitely look at, and it's called LRP, just so you have that name. And it's on the USDA website, and they can run. It has all the details and what's on it, what they do, and how they hedge, and how the put price is determined. And again, it's limited on the amount of head that you can hedge. And for the life of me, I cannot remember what that number is. I apologize, but it's definitely on the USDA website. Just type in Livestock Risk Program and their search engine, and you'll find it.
Great, thanks so much, Tony. So as we wrap things up tonight, I'll just go ahead and give you the floor to give us some parting wisdom. What's any words of advice for producers, just to wrap things up for the night?
The one thing that I'd leave you with here is this is not easy. This is something that takes work, it takes time, it takes effort. But as you can look, in the last 3 years, we get a plant fire in Holcomb, Kansas. We get a ransomware attack at JPS. We get COVID. We get these shocks to the system, and we can't plan on it, and we just don't know when these things are going to happen. So, in other words, I'll keep going back to this statement from a cattle feeder I really enjoy. If you're not hedged, you're playing defense. And it just doesn't make sense to play defense. You've got to get on the offense, and it gives you more alternatives to have your plan. And everyone's going to have a different plan. Don't expect to be the same to everyone. Your costs are different. Your potential break-evens are different. But it's spend the time to educate yourself on this. We just can't keep going through and taking these kind of hits and make this an ongoing concern. So I wish y'all luck. Like I said, if you're in Nashville, look me up. Love to see y'all. And if you've got my email address, if you've got any more, love to answer those as well. And thank you again to NCB and NCBA for allowing me to do this.
Well, thank you so much, Tony, and thanks for everyone for jumping on with us tonight, and we hope to see everyone in Nashville. Have a great night.